The Building Show, where ideas connect. For 34 years, The Building Show is where people connect through Construct Canada, PM Expo, Home Builder and Renovator Expo, and the World of Concrete Toronto Pavilion. Visit the Metro Toronto Convention Centre South from November 30th to December 2nd to make the connections which will give you a competitive edge. For more information, email events@informacanada.com or visit thebuildingshow.com. Hello and welcome to the Construction Record Podcast. I'm digital media editor Warren Fry. On this episode, we'll hear from several speakers who recently presented ConstructConnect's latest economic webcast held on November 15th. It's been a tumultuous year for both construction and the economy in general, and each expert examined how current and future conditions affect the industry. Up first is American Institute of Architects chief economist Kermit Baker, who looked at major leading economic indicators and how long of a recession is in store for us.
Indicators that lead future economic trends are generally pointing down, and most economists now feel that the probability of a national economic recession over the coming year is quite high. However, they also feel that if we do see a recession, it'll be a very mild one, and that it'll be relatively short-lived. So a popular scenario is that the Federal Reserve Board will stop raising interest rates around mid-year next year, maybe even as early as the end of the first quarter, and they could even begin cutting interest rates by early 2024, so we'll see. A federal program that's going to impact the construction outlook is the recently enacted Inflation Reduction Act, which is a significantly scaled back version of Biden's Build Back Better proposal. Most of the climate provisions remained in the final legislation with the goal of reducing carbon emissions by financing and focusing on renewable energy sources. So there also were incentives for using renewable energy sources to make homes and buildings more energy efficient. I'll talk to that in just a second. And extensions to the Affordable Care Act and a minimum tax for corporations. On the next slide, we talk about the features of this program that had a direct impact on construction activity. There are incentives for home retrofits, for things like heat pumps, increased energy efficiency retrofits, more efficient appliances that should boost construction and reconstruction activity over coming years. On the commercial side, the energy efficient commercial building deduction, commonly known as Section 179D, has been greatly expanded for new buildings that achieve at least a 25% reduction in annual energy costs. And that tax deduction is figured on a sliding scale. Let me move over to kind of construction and design activity and begin by looking at the current status of non-residential building activity nationally. So spending on buildings declined through last year, but by the end of the year, that decline had begun moderating. For the year as a whole, spending on non-residential buildings was down just about 5% over 2020 levels, less on the commercial industrial side, more on the institutional side. And this chart looks at the performance so far this year, and we're beginning to see the beginnings of a rebound, as you can see. Spending is up through 6% through the first 9 months of the year. Strong growth on the retail and warehouse side of the commercial market. Very strong growth on the manufacturing side, and healthy gains for healthcare facilities. Next slide. With all the inflation that we're seeing in construction costs, both on the material side as well as the labor side, it's hard to know how much of this growth in spending is actually reflecting growth in construction output and how much just is reflecting the higher costs of construction that we're seeing. So one way to help sort this out is by looking at employment levels in the industry. So non-residential building employment, as you see here, was fairly level from the time it bottomed out as the pandemic hit up until late last year. However, over the past year, employment has increased well over 3%, suggesting that there's more than just higher costs pushing up construction spending in this sector. Higher construction levels would also indicate higher output. Next slide looks at our Architecture Billings Index and give us a sense of where the industry is headed. And it continues to show generally favorable business conditions at architecture firms. So design activity precedes construction activity, and our research indicates that the ABI accurately predicts construction activity with a 9 to 12 month lead. So in terms of recent trends, after a strong upturn in 2021, scores began slowing in the fourth quarter of last year, which continued through January and February of this year, but we saw a bit of a rebound this past spring, more moderate growth over the summer. The September reading showed growth, but growth continues to be quite modest.
Next, we have Associated General Contractors of America economist Ken Simonson, who looks at residential versus non-residential conditions and how with changing work conditions, some of construction's premiums aren't as attractive as they once were.
One reason that contractors have not been able to build up their employment levels enough is that there just aren't enough workers out there. In fact, job openings at the end of September in construction were at an all-time high for that month, 412,000. That exceeded the number of people hired during the entire month of September by a hefty margin. And we've seen similar graphs for each month this year, where the job openings at the end of the month are a record compared to the previous 21 years of history for that month. And in many months have exceeded the number of openings, and the number of people hired, implying that the industry wanted to hire twice as many people as it was able to bring on board. Well, a major reason they're having trouble doing that is that other industries have increased pay more sharply than construction. We used to see that the so-called premium for non-supervisory workers in construction was 20 to 23% more than in other industries. Once the pandemic hit and you had industries that historically paid minimum wage for beginning workers boost that pay to $16 or $18 an hour, the premium to work in construction dropped to 16%. It's come up a little bit now, but there's still a challenge that construction work has to be done on site in any kinds of weather, starting earlier than I like to get up during the morning. And other jobs now offer a lot more flexibility, work from home, hybrid, flexible hours, pick your days to come into the office, and maybe even be able to take off in the middle of the day if a school calls and says you got to pick up your kid. And if you're on top of a multi-story building or way out on a remote site, you can't do that in construction. So I do think construction will have a continuing challenge filling jobs. Well, let me switch to one other topic here, which is what's going on with different spending categories. Overall, total construction spending was up by 11%. But as you'll be hearing from the ConstructConnect figures, if you look at starts, you get a different picture. Both the census numbers and ConstructConnect numbers, however, depend on are only reporting current dollars. So unfortunately, as Kermit said, we don't know how much of this is actual new square footage or linear feet of pipe or lane miles of highway. How much is price increase? At any rate, most of these do show an increase from September 2021 to September of 2022. But I think going forward, it really is going to be quite a mix of what's happening. I am optimistic that we will be able to avoid recession and that construction as a whole will grow, but it's going to have quite a change. All of the developer finance categories are being hit by rising interest rates, rising construction costs for many materials, and more resistance now to rent increases. And so that makes multifamily, warehouse, retail, office, and lodging very vulnerable. On the plus side, though, we've had three big federal laws that will help construction. The Infrastructure Investment and Jobs Act will help many categories in infrastructure. The CHIPS Plus Science Act has already been giving a boost to fab plants. The Inflation Reduction Act giving a lot of incentives for alternative energy. And all of these things will stimulate additional onshore manufacturing, which has also been getting a boost from demand for electric vehicles and many other things.
Next up is ConstructConnect's Senior Director of Project Strategy Data, Fonda Rosenfeldt, who takes a deep dive into the numbers from the past few years when the pandemic changed everything.
I want to say that today, everyone on this call We all have something very big in common. Each and every one of us in our lifetimes, we've survived a pandemic. So congratulations. Having been in this for 2.5 years, we're all pandemic subject matter experts in that we have navigated ourselves and our businesses through these strange, weird times and have kept things going. So what have we learned? We've learned that we are resourceful in keeping business moving. And what I have learned personally is it's impossible to avoid certain words such as unprecedented, unpredictable, challenging, and still shake your head downright crazy. But this graph will serve as a reminder that prior to 2020, our world of construction and seasonality, it was really something you could bank on. It was predictable. We knew from years and years of tracking trends and projects that we could count on seasonality in our business. We know that we experience growth through first quarter in bid volumes. Those volumes taper off and start to fall in Q2. And then in Q3, we'll experience maybe a little bump in activity and then leveling off and falling volumes through Q4. So aside from a blip here and there, those trends have really remained steady. And as a reminder, our 2020 bid volumes were performing ahead of 2019 by 5% in general building and 2% in civil. Canada is trending at a little bit more of a conservative rate. Canada's pandemic response and recovery differed in that they had a swift downturn in Q1 and Q2 of 2020, but then saw some quick recovery to normalize bid volumes and activity by July of 2020.
In this next clip, Rosenfeldt looks at how project data has changed over the last several years.
So in 2019, project data had a ratio of general to civil projects favoring general work, and this was around 8 to 10%. Quarter to quarter over the last 2 years, we have seen a steady shift in project makeup to nearly even, so 50% civil and 50% general. Federal stimulus dollars infused $1 trillion. That may bear some of the reason for the impact, as nearly every infrastructure category we are showing has increased, and that includes your roads, your bridges, your power, your concrete, your communication, and recreation. Increases are also significant in vertical construction, notably in education, municipal, and surprisingly restaurant and entertainment, but that's offset by slower growth or declines in some other sectors such as office construction. Our national reporting team did a Q3 2022 industry insider, and they've called out tech giants such as Meta and Amazon as reconsidering planned costly office expansions as they weigh alternate and hybrid work solutions. So no doubt others too are considering that model. On the next slide, we're also going to see average project cost is on the rise. So no surprise what we're hearing from the economists that we're seeing increases in the average award value for bid projects. That's not consistent from sector to sector. Education project volumes, for example, are up more than 14%, but that average value is up more than 50%. Municipal work up 12 with 30% increase in value. Road work, though, up by about 5%, is a 40% increase on value. Even that said, manufacturing, multi-residential, and large arenas and stadiums are some of those areas we're seeing with even bigger increase. With ongoing volatility and availability of market and labor, these increases are to be expected. Some really high project value mega projects this year we've seen, they include Pittsburgh Airport, a new lock in Sault Ste. Marie, and the Air and Water Resource Recovery Facility in Ontario. Wrapping up, ConstructConnect, we're seeing more projects we did in the prior 12 months. We're seeing increased bid volumes and continued with November bid dates well ahead of 2021 by 16%. We've aggregated a record number of bidding documents that we pull a lot of our data from as well because of those increases in bid. Our industry insider, again, with the focus on national retails, they're citing growth in restaurants, quick brands such as Taco John's, planning over 50 new locations. They're also reporting, some adjustments that brick and mortar stores are making. Big stores, department stores, rebranding and co-branding as smaller stores or nesting smaller boutique spaces within their larger locations. So we're seeing some adjustments being made. We're seeing more work, both public and private, both civil and general. Material, labor cost, and availability, and again, continue to impact the cost of construction. So more work and more expensive.
ConstructConnect senior economist Alex Carrick is next with a look at how the need to go to net zero is going to be nothing less than another paradigm shift like the Industrial Revolution in the 1800s and the tech revolution at the end of the 20th century.
What I would say is that I am really optimistic about the outlook for construction over the longer term. And I really think that there's a movement underway that's as important as the Industrial Revolution at the end of the 1800s and the high-tech boom at the end of the 1900s. And that movement that I am talking about is the movement whereby the whole world is moving towards NZE by mid-century. Forget COP27, forget the Paris Accord. There's generally a consensus that the world is going to have to move to zero carbon emissions over the next couple of decades. And just think about what that will mean. That's just got huge implications in terms of the need for expanded power generation. And for commodity markets, there's in the foreseeable future, there's going to be another commodity super cycle. And for the kind of jobs that are out there, the labor demands and what people will be doing. And you think, well, that's a ways away. That's 27 years away. Well, 27 years really isn't very far because you've got to make some major investments right now. And the auto firms are buying into this. Like the major auto companies are spending really big dollars. And we're seeing the implications of this NZE by mid-century now, right now in terms of mega projects. Because 2022 will be the strongest year ever for mega projects being projects of $1 billion or more each. And these are the projects that we've had so far this year. And if you go down that list, you'll see wind farm, LNG projects, semiconductor manufacturing plants, battery plants, and then even in the last month, because it was so strong, I keep waiting for this to somewhat tail off. But even in October, we had 3 more mega projects for more than $1 billion each. And one of them was the Hyundai plant in Georgia, and one was an ammonia plant in Texas. And then there was a big hospital project in Boston. So they keep on coming. And with regard to these mega projects, they're not necessarily influenced by commercial bank interest rates because they have other sources of funding.
Next, Carrick examines some of the big projects being built or on the way that may stave off or slow down a recession.
Now, there's other trends that are underway as well. For example, the population is aging. And what does that mean? Well, before the pandemic, there were all kinds of big airport projects. And I thought that they might dry up because people weren't traveling as much and so on. But coming out of the pandemic, people want to get back to traveling. And with an aging population, you've got a whole bunch of people who have bucket lists and they want to go somewhere. So again, I'm feeling positive about the prospects for airport work. And also with an aging population, you need more medical facilities. And as I say, in the top 10 lists and in the mega project lists, there are a number of significant hospitals. And then just going down the notes on this page, I talk about how entertainment is something that's becoming so big. During the pandemic, we all got into streaming and so on. There's a project that I really like because it seems to capture a real trend, and it's a new studio, $1 billion studio that's being proposed in New Jersey. And what it's going to do is replace a former Texaco refinery, and because it's on the shoreline, part of the capital spending, a big chunk of the capital spending, will be on elevation, elevating the site so it won't be overwhelmed if there's bad storms and bad weather. So we have GDP growth. And the first 2 quarters of this year really were quite weak, but the third quarter had growth of 2.6% real GDP. The long-term average annual growth rate in the U.S. economy is 2%. So we don't have recession yet. Everybody seems to be in agreement that there's going to be recession at some point because of the increase in interest rates. But the economy's doing better than probably most people think. And in fact, in the latest set of revisions to the GDP numbers, the pandemic decline was revised to minus 2.8%, which wasn't much different from the minus 2.6% for 2009. Also, it's interesting the support in the third quarter of this year came from trade, a pretty unlikely source, except that energy prices have gone up and the U.S. is now exporting oil and natural gas, a lot of it going to Europe because there's this huge energy price differential. And this has tremendous implications for really big projects, big LNG projects and petrochemical projects and so on.
Finally, we have ConstructConnect's senior economist Michael Guckes, who looked at energy's role in the construction economy.
So one of the things that we've seen that maybe isn't as pronounced in the U.S. news is just the incredible skyrocketing price of energy over in Europe. And it is really transforming that industry, all of the industries that are reliant on energy, which is to say every industry, because really the two major factors that underlie the operations of every firm are labor and energy in some form or another. As Kermit pointed out, there's a need for high efficiency products. He talked about rebates. The need for energy efficient products and an energy efficient mindset is going to affect not just the Europeans, but it's even going to affect here in the US as well. Earlier this year, the Wall Street Journal put out a great article about what's happening at New England ISO. It's an energy provider up in New England serving New Hampshire, Vermont, Maine, a few other states. And what's happening there because of certain regulations, right? The challenges of shipping gas around is already increasing prices here in the US as well. Aside from increasing our costs of operations, the other thing is that energy is going to present one of the largest, I think, opportunities for the construction industry moving forward. As we look at what was once a global energy market, we may very well end up with a bifurcated energy market in which sources of energy produced out of Russia and are sent to Asia, China specifically, and some other places, that will become one market. There will be a second market, which will be essentially largely supplied by the US, Canada. It's undetermined as to what will happen with Middle East production. But the natural gas in North America that is extracted out of the ground here, that's going to need new logistical support, new pipelines, new ships, new terminals, all of these things. And so as that market transforms, there's incredible opportunity there. So not only do we have an opportunity, but we also need to be very careful about how we're going to manage our energy expenses, not only this winter, but also very likely next winter as well. So I basically covered a lot of this, right? Talking about energy efficient production methods and investments, the increased demand for energy efficient construction products. The other thing to talk about too is how do North American manufacturers of building products become energy exporters through the metal products and the glass products and the plastics products that all are very energy intensive to produce. And in fact, I think it was Ken who mentioned how material cost price are changing drastically, especially in the metals and plastics areas, and also copper he had mentioned. So all of these things are an opportunity where North American manufacturers may have a competitive advantage to provide a larger part of the world these kinds of energy-intensive goods than they have in the past.
Guckes also looked at supply chains and how, despite a push to localize, global supply chains will continue to dominate.
One of the things that we're seeing already is an increase in inventory to sales ratios, and we can really dig into those ratios. We can look at it for just durable goods. We can even look at it within other smaller elements of the economy. But one thing overall that we're seeing is that construction inventory to sales ratios are really at sort of the higher end of the cyclical trends that we see over multiple business cycles. This is just the last roughly 15 to 20 years of data. And you can see that blue line, inventory to sales are already quite high. The interesting thing here is that construction materials inventory in millions of 2019 dollars. So this is accounting for all that inflation that we've seen over the last 2 years that the prior speakers talked about, right? We're actually seeing a little bit of a decline here in the real value of that inventory. And so, that tells us something about sales. If the inventories are declining and your inventory to sales ratio is increasing, it tells us that really there's some stress there on the sales side. All right, the other part to this that doesn't get a whole lot of attention, so I thought I would bring it up as the final speaker, is just what's happening with import prices. And the interesting thing is that in China, producer price indices they've turned a corner here. You can see that this is year over year, and it's just barely above the 0% change here. If you look at the month-on-month figures, actually, these numbers have largely been negative since July. So we're already seeing a correction in those foreign manufacturing costs, or at least the producer price indices. So we're seeing some significant and helpful change here if you're still importing goods from Asia. U.S. import prices, of course, they closely follow what's happening with Chinese producer prices. So we can expect more improvement from the cost of imported goods. So one of the reasons for this is because of the strength of the U.S. dollar. And in fact, against the Chinese yuan, it's appreciated 14%, I believe, in the year-to-date period. Overall, the U.S. dollar against a broad basket of currencies is up to 17% on average across that basket of currencies. And so the strength of the U.S. dollar, which has been in part due to the rising interest rate environment that we have here, has allowed for imported goods to be much cheaper when purchased, with U.S. dollars. So all of these things are going to, I think, change the nature of what we've thought about supply chains for the last 2 years. A lot of time was spent, as I talked to manufacturers the last 2 years, a lot of time was spent on, how are we going to bring in supply chains? How are we going to domesticate them, or at least continentalize them? I think what we're going to end up with long run is something that's more of a hybrid, and we're going to be still going back, and expanding those supply chains to something that they looked more like pre-pandemic for all these reasons, because the cost structures just make it too profitable not to.
If you'd like to view the entire session, it's available along with previous webcasts at ConstructConnect.com/webcast-videos. And that's it for the Construction Record Podcast. You can hear us on Amazon Music, Apple Music, and Spotify, or on the Daily Commercial News and Journal of Commerce websites. Thanks for listening.